answering your tough financial questions for the past 26 years. It's Allworth's Money Matters with co-hosts Scott Hansen and Pat McClain. Would you like an opinion on a financial matter you're dealing with? Whether it's about retirement, investments, taxes, or 401ks, Scott Hansen and Pat McClain would like to help you by answering your call. To join Allworth's Money Matters, call now at 833-99-WORTH. That's 833-99-WORTH.
Welcome to Allworth Financial's Money Matters. I'm Scott Hansen.
I'm Pat McClain.
Glad you are with us. Both myself and my co-host here, we're both financial advisors, certified financial planner, chartered financial consultant. We spend our weekdays with people like yourself, and we come here on your weekends to be your financial advisors on the air. So glad you are with us and being part of the program. And
thanks for being here.
As usual, we've got a phenomenal show lined up.
Well, that's kind of dependent on the callers a little bit too, isn't it? How do you know it's phenomenal? We haven't done it yet.
Well, it's just one of those teases that you just I learned early on.
Remember we had a radio coach for a little while. We first started doing it.
I don't think it was helpful. 22
or 23 years ago. No, I don't think it was a waste of money. That's a lot like my little league coach. It was he was wasting his time on me. There wasn't anything.
Your little league coach
wasn't anything he was going to do to make me a good baseball player.
You were not a good baseball player?
No, I'm not much of an athlete.
All right. Well,
I liked sports,
but you are a great financial advisor.
Okay.
And I don't think people are listening to the program to hear about your lack of athleticism on the baseball field.
All right. Well, fair enough.
Just saying.
Fair enough.
So if you would like to join us, you've got a call and would like to be part of the program, love to hear from you. Our number to join the program is toll-free 833-99-WORTH. That's 833-999-6784. And that'll get you on Allworth Financial's Money Matters with Scott Hansen and Pat McClain. Of course, Allworth Financial is the new name of Hansen McClain, as well as some other companies for that matter. But we've banded together and we are Allworth Financial. And we're starting out in Northern California talking with Mike. Mike, you're with Allworth Financial.
Hi, guys. Thanks for having me on.
Thank you, Mike.
So I just recently started shutting down my company I've owned for the last 10 years and transitioned into a new position, making about $125 a year. And with shutting down my business, I now have about $75K available to move into investments.
This is going much better than I thought the call was going to go, because you said, I'm shutting down my business.
I was thinking he was going to say $75,000 in losses.
And then I thought, oh, no. And then you got like, all right, well, you got a good job. And then you said, like, oh, you got a bunch of debt now you're trying to figure out, or you owe.
Yeah, when he said, I've got $75,000, I thought, credit card, roll forward losses. But
no,
you have
positive. It's all positive.
Okay,
here.
good. All right, sorry, I had to interrupt. Continue on.
All right, so $75,000.
No
and how is that held? When you say 75, is it in cash or is it in IRA?
Yeah, it's currently in cash.
Okay.
I have another about 25 coming in from accounts that I'm just finishing up some work on, some contracts that I'm just wrapping up. So once we get those done, we'll have about 100 ready to move forward into other future things. I don't have a ton of current retirement set up. I'm 41 years old with 3 kids. I have probably $25,000 in 401k from a previous company.
Did you sell any of your assets?
No, this is all just contracts. Coming to closures. So I don't have a ton of retirement investment set up, but I am with my new company. I've got a 3% match on 6% of my income, so 9% going into the current company's 401k program through starts with a P. I just got their
principal.
I just got their enrollment package a couple days ago. So I've got this 100,000 that I'm looking towards moving into something. We just also got gifted a portion of a trust, which is also the house that we rent and now are members of the trust on. So buying a house isn't probably the best investment choice, as we're already members of this trust that owns the house.
Can you speak into that a little bit more?
Yeah. So let's ask a couple. We're gonna ask a couple questions along the way. What you're making?
And by the way, these now every situation would have different questions, but these are the kind of questions that one needs to ask before you can choose what the right investment is. Sometimes people say, "Hey, Scott, I've got this money. What should I invest in?" Well,
I don't know. I don't know anything about you.
I mean, it's so that's really trying to figure out what's going on here.
You're making $125,000 a year on your job now. What was the best year take home that you made before?
Yeah, or what'd you average the last few years?
Yeah.
Best year was about 237. Most years I was taking somewhere between 80 and 150.
Okay, so this is about the same. It's
Pretty
not a
close.
change or up or down. On average, it's about the same. Okay, and does your wife work outside of the home?
She does. She brings in about 27,000 a year.
And does she have a 401k or 403b available to her?
No.
Okay. All right. So let's talk about this trust a little bit. Tell us about it. Where did it come from? You say you're part owner. Who are the other part owners?
We have been, my wife and I have been renting this house in the Sacramento, California area for the last 4.5 years from an older gentleman who has become incapacitated over the last 7 years, has no friends or family. We knew the neighbor, and through knowing the neighbor, started to get to know this gentleman. Started helping take his mail to him in a nursing home. Started to go and be kind of an advocate for him. About a year goes by, year and a half goes by, and he said, "Hey, do you guys still want to rent my house?" So it's a decent place, 2,600 square foot, about $520,000 house. And we're renting it for a ridiculously low amount of money in exchange for helping him with taking care of his financial assets, taking care of his insurance, helping be a friend, be a family.
And will you inherit this house when he passes?
Yeah, we just finished setting up the trust about a month and a half ago. He is the executor of the trust. We are the only beneficiaries of the trust. Well, my wife and I, along with, if anything were to happen to us, then our youngest son.
And how old is he?
Beneficiary. 77.
Okay.
And you are the sole beneficiary of his trust.
Correct.
And is there any other assets other than this home in the trust?
A bank account that has like $6,000 in it.
Okay.
So is he in a state? How's he paying for his long-term care? He's in a facility? Is that correct?
Correct. Yeah, he's having a very tough time paying for it because Medicare is not covering all of the benefits, and so that's part of the reason for the trust being established.
Well, there's a good chance there's going to be a claim against the trust at his death from Medi-Cal. When you say Medicare, it will be Medi-Cal.
Right. Sorry, I get them mixed up.
But there's a good chance that there'll be a claim against the estate, which is the trust. So
in other words, if he's not paying, he has assets, right?
The house is the only one. Yeah.
Yes, correct. But it is an asset and it has value.
Correct.
And he gifted it to you, and you went to a qualified attorney, and they probably tried to get it out of the estate, and they talked about all the good and bad things about what they were doing. Fair?
Correct. Yeah.
Okay. So if I were you, I would expect that there'll be a claim against that house for the estate.
Which might mean you have to have some
liquidity. To pay
some money back.
To pay it down. So that's why.
Still.
Oh, listen, Scott.
Still a great deal for you.
Listen, and I'm sure that wasn't your intention when you got close to the person. I think that.
Yeah, of course, yeah.
The world works in mysterious ways. Now, in saying all that, the reason we asked the question is you asked us, what do I do with this $100,000 that you've got? $75,000 in cash and $25,000 in receivables. I would keep it in the bank. I'd go to an online lender or online bank, and I would just put it in the bank. So I'd go to bankrate.com.
And why would you just keep it in the bank for now?
Because I would expect that this man is going to pass in the next year or two, and that I would expect a claim from the state of California against the estate, which may be $50,000, $150,000, $300,000. We have no idea.
Well, depending on how many years he required care.
We don't know. And we don't know what the rate is on a monthly basis, but I'm going to assume it's somewhere between $4,000 and $6,000 a month.
Nor do we know if there can be some deal cut at that point in time.
We don't know that. But what we do know is once it becomes your house, you have a couple of choices. One is you could just pay it down. The other is you could refinance it and take cash out in order to pay the state off. But I would want some liquidity at that point in time.
Totally agree with you.
At the same time, I would probably increase my 401k to a minimum of 6% and possibly...
He's at 6%.
No, he's not at 6%. That's including his match.
I'm putting in 6%. They're putting in a 3% match, so it's a total of 9% going into the 401k.
I stand corrected.
I would still put in more in the 401k.
I'd put in 10.
At least 10. You're 41 years old.
I know, but he's got 3 kids at home, and it's just a big change in his income. And the house is a good possibility is going to be paid off in a year or two. You're paying rent now. There's a chance in a year or two you're not going to pay rent.
How much rent are you paying?
$1,700.
Yeah, okay. Agreed, Pat.
So
10% your 401k, and I'd use stick this money aside. Just earmark it like
it's just there. Don't even pay attention to it. Wait until you see how the rest of this thing plays out.
Yep,
right?
Totally.
There's
agree.
a lot
we've
that
got
can
it moved aside into a savings account right now, but at our current bank. But it would be better to look up a higher.
Yeah, you can get a couple
2%,
a little over 2%.
Yeah, you're probably getting 1/4% or 1/3%. Now you get 2%. It's like $1,500 a year to you. Just go to bankrate.com and use any one of those. They're all FDIC insured. It's where I keep my cash.
Great.
And things can change. Much like you were named the beneficiary on this trust, someone else could be named the beneficiary of a trust tomorrow.
Exactly. Yeah.
It's not irrevocable.
We're definitely aware of that.
Yeah,
Yep.
That's why we like the idea. Just keep it in cash until, like Pat says, see how this thing plays out.
Yeah, and I mean we don't want anything to play out, but that's just
No, I know it's reality.
listen,
no one gets out of here alive, right? I mean,
it's-
last I looked.
You know, and you didn't befriend him to get the asset. It just happened. And quite frankly, he's probably happy that he found someone that he likes, loves, and trusts that he can give it to.
I would think.
Right? You
Yep,
probably
yep, absolutely.
you did
And we're
something
glad
for
to have
him.
him.
Yeah. Right? So appreciate the call.
Yeah.
Good guy.
Thanks
All
for
right,
calling.
thank you guys.
All right, wish you well, Mike. And if you'd like to join our program, we do appreciate calls from our listeners. It could be on just about anything financially related, from estate planning to retirement planning to investments to taxes, insurance, Social Security, college savings, just about anything you can think of financially. We'd love to take your call. 833-99-WORTH is the number, 833-99-WORTH. And let's go to Gary. Gary, you're with Allworth Financial.
Yes, thanks for taking my call, Scott. I enjoyed the book. I haven't read it all, but it's really informative. I appreciated the book.
Well, thank you. How can we help you, Gary? Pat's with
Got
me
a
too, by the way.
question.
I'm that's okay, Gary. I'm not used to compliments. The 5 kids I grew up with, they weren't passed around very often.
I hear you. That's right. That's mine. No, my question relates to some property we bought back in like 69. I was still in college.
How did you
And
buy
we,
property when you were in college?
Well, we worked on a farm, so we had a lot of resources in terms of land and timber and that sort of thing, and it wasn't that expensive back then like it is now.
Got it.
So I worked it in the summer and paid it off like in 3 years.
Oh, good for you.
Wow.
Good for you. What are you thinking of doing with this property?
Selling it. That was our retirement.
And what did you pay for this property?
Like $30,000.
And is it land or a house?
It's just land.
Okay.
It's raw land. It's just beautiful North Carolina, Western North Carolina property. Just beautiful.
And what do you think you could get for it?
Probably around 400,000 or so.
Okay.
And is it on the market now? Are you in a contract or?
It is. It's actually we've got a contract on it for that. So
Okay.
we're pretty excited. You know, we'd never considered selling it. It was something I was hoping maybe even pass on to my grandkids, but we just decided to get rid of the tax burden and all that.
Now, have you calculated what you have to pay in capital gain taxes on this?
Yeah, that's going to be pretty steep. It
Yeah.
looks like it's going to be about $80,000.
Yep.
That sounds about right.
Yeah, that's just Uncle Sam gets his. I know that.
So you're gonna net 320. So your question for us is?
Yeah, what? I don't know if that's enough. I saw in Social Security, if you make it to 66, which I am, you're more likely to live to be like 85. So I've got about 20 years here, maybe.
And so you want to turn this into some retirement income, is what it sounds like.
Income, I do. I want to pay off our house in 5 years.
What do you owe on your house now?
Only about 95.
And what's the interest rate on the house?
4.75.
What if we
Pretty
said?
good.
What if we said for a portion of these dollars we had a guaranteed investment? Now, very often we say guarantees in this, but we're going to say guaranteed 4.75%.
No risk whatsoever. You give us, let's say, $95,000, and I guarantee you I can get you 4.75% without any market risk at all. Any market risk. What would you think?
That would be outstanding.
All right.
Then pay off the mortgage.
Pay off
Number
the
one.
mortgage. Pay off the mortgage. There you go.
But really, just pay it off
Absolutely.
right up front.
Just write a check.
How much are your payments on that house?
Just a little over $600.
Yeah, so right there, that's going to save you $600 a month.
Yeah, actually
I know that.
more than that, because income that you make, you pay taxes on, and then you take the remainder and you make your mortgage payment.
Right.
So that's the first thing we would do, because 4.75 is a relatively high interest rate on a mortgage in this environment.
They could, now some might argue, go out and refinance, but at this stage in life, we don't think having a mortgage is prudent at all.
Yeah, I've tried that. It only knocks the mortgage payment down maybe $30 or so. It's not much.
Oh,
it's not a large amount.
Yeah. So you just want to pay the whole thing off.
I'd pay it off, and that would leave you with about $225,000. How much income are you hoping to generate off these investments?
That's hard to say. We probably don't make enough on Social Security to get through each month. So I work in addition part-time. But it's a good part-time paying job. So I don't know how much longer I can keep doing that.
How much
probably I would think $1,000 a month, something like that.
And how much, so you're working part-time now and not receiving Social Security. Is that correct?
No, I am getting Social
Security. You are?
Security.
Okay.
I waited till 66 to retire.
Okay. And how much money are you making at your part-time job?
Probably about $1,500 a month or so.
And you said $1,000 a month. If your mortgage was paid off, would you still need that much?
Probably not.
Yeah. So let's say your mortgage is paid off. That's $600 a month, and let's say $225,000. You had it in a diversified portfolio. Let's say you were withdrawing at 4% of that. That'd be about $9,000 a year.
Call it $750 a month. Is what that would be. Yeah.
Yeah, that would really knock a big hole in the monthly allowances I would need.
Yeah, you're probably going to be net ahead. So what you want to do is, or I'd go one step further. I'd say, look, if you're working part-time and you can afford to not take any distribution from this.
Yeah, have the mortgage paid off.
Have the mortgage paid off. Live on the Social Security and the part-time income and let these dollars grow until you don't work anymore.
Yep.
And then start the distribution on that. So because you mentioned the 7 personal decisions.
I'm going to throw one other thing out there off there. Another option is when you sell this, do a tax-free exchange into a rental home. And
I love that.
Use the income from that.
Because we're real good on fixer-uppers. That's what we bought. We bought it at $100, and it's worth probably $170 now.
I mean, I don't know if.
Wow. Can you do that?
Oh, you certainly. Oh, my gosh, you could do it. You could do it into 2 properties if you wanted to.
Yep.
You
You could sell for $400,000, get two properties at $200,000. Maybe if they were a little more spendy than that, you had a small mortgage on each one.
Yeah.
Scott,
If
when
you have experience with rentals,
are you kind? So, I'm going to make an admission here. I got off the phone with my handyman an hour ago, because I'm not very good at that sort of thing. But if you're good at that sort of thing, I don't think it's anything you should discount. Do you have any money anywhere else? Do you have money in IRAs or 401ks or anything like that?
Yeah.
How much?
Probably about 25.
Okay. So, listen,
if you were my father or older brother, you've had experience with rentals, I would probably recommend doing a 1031 tax-free exchange.
at least for some, if not all of the money.
At least for some, if not all the money, into a rental property. Maybe not all, maybe 300,000 of it.
Yeah, you take some money
Or
out,
270 or something
take some
like
money
that.
out, pay off the mortgage, and look at a rental for the rest. So I kind of like that idea, Scott.
Yeah, and that gives you you're comfortable with rentals, and you like that idea. I would look at that. You want to do that before your house goes before it's sold. You need to have an intermediary lined up ahead of time. But anyway, that's a lot of options to consider there, Gary. Appreciate your call. And let's continue on. 833-99-WORTH. We're talking to Christy. Christy, you're with Allworth Financial.
Well, hi.
Hi, Christy.
I've been listening to your show for years, and I've enjoyed it so much.
Oh, great. Thanks.
My question is, I've watched over the years people do very well in real estate, but I don't want to be a landlord, and I was wondering what you thought of investing in REITs as an alternative.
Where did you learn about REITs?
Well,
Okay. So
I know a few things.
Okay. Let's kind of step back.
Let's talk about REITs.
So, what a real estate investment trust, a REIT, is, it's a special type of corporation that avoids a double taxation, provided that, I believe it's 90% of its operations are in real estate, and they distribute, I think it's 95% of the income to its shareholders. So it's a special structure of a corporation that is called a REIT that can distribute the income and avoid the double taxation. There are two broad categories of REITs, of structures. One is what's called a publicly traded REIT,
Which trades very similar to a stock
just like other kind of companies.
or a bond.
They're companies that own real estate, apartment buildings, commercial properties.
And
whatever.
sometimes they specialize in certain sectors. Some might only own retail. Some might only own apartments.
Shopping malls.
Some might only own golf courses.
Then there are what are called private placement real estate investment trusts.
Or non-traded real estate investment trusts.
And these are ones that are
Sold to you by high-commissioned brokers.
yes. So when you first brought up this REITs, I think publicly traded REITs can be great in a portfolio.
I think a mutual fund of publicly traded REITs can be
or an ETF.
a great addition to your portfolio.
What we don't care about are these non-traded REITs that are sold through brokers.
Gotcha.
So if someone comes to your house or to your place of business,
Or you visit with them.
or you go to them, and they recommend a non-traded REIT, also, and they'll disguise it as 1,000 different things, uncommon investment, or
Is
you know,
someone
not correlated to the market.
Has someone recommended these to you?
Oh, that your comment sounds so familiar. But no, I know about these because I've studied them a little
Got
bit,
it.
and I was in fact speaking about traded REITs and mutual fund
Perfect.
of REITs. But my concern lately has been retail's kind of under pressure.
But there's more than retail REITs.
Yeah.
Right? There's all kinds
Yeah,
of different
right.
REITs, right? There's mini storage REITs. There are
Right. In my hometown, which is a college town, there are college apartment REITs.
That's correct. That is
who
correct.
own half the town. Yes, I understand.
That is correct. That is correct. So, as a portion of your portfolio, they make a lot of sense. Don't go hog wild on them. Remember, real estate is just another asset class. There's nothing special about it or not special about it. It hasn't historically over a long period of time either underperformed other asset classes. No. So don't, people will ask all the time, is real estate good? Can be. Are stocks good? Can be. Bonds good? Can be.
Well, and it's just it all depends on what the real estate is,
when you buy
location,
it, when
what
you
kind of
sell
debt
it,
structures on it, what's the management of it.
Yeah. So, if you were to put, I don't know, 10, 15% of your portfolio in REITs,
yeah,
I wouldn't overdo it. I wouldn't overdo it, but I don't think you'd hurt yourself at all. Huh? Nope.
All right.
All right, Christy. Thanks for the call.
Thanks.
Yeah, and
it's called from Garden Valley.
Garden Valley.
My brother has a place in Garden Valley.
Is that Garden Valley, that little tiny town?
You bike ride up near there. Yeah. It's on the backside of Coloma. You climb that big hill.
Yeah. Prospector, and on the other side is Little Garden Valley.
Do you climb Prospector?
Yeah.
How many times have you climbed it?
I don't know, a dozen or 20 or something.
Not me.
We are going to take a quick break, and love to take some calls as well when we come back. So if you want to join us, 1-833-99-WORTH. This is Scott Hansen and Pat McClain of Allworth Financial. We'll be right back.
Can't get enough of Allworth's Money Matters? Visit allworthfinancial.com/radio to listen to the Money Matters podcast. Do you have a financial question that needs answering? Call us at 833-99-WORTH. That's 833-99-WORTH.
Welcome back to Allworth Financial's Money Matters. I'm Scott Hansen.
I'm Pat McClain.
And
thanks for staying with us into the second half of the marvelous show.
It's
incredible.
So we've seen there's so many interest rates in European governments that are negative.
Crazy.
That, frankly, it is hard to wrap my head around.
It's.
I mean, I've got a degree in finance. I've been in this industry almost 30 years. And as an example, Sweden there's a bank that has a loan program. If you do a 10-year loan,
10 years, you borrow money,
your interest rate is
negative
0.5%.
Now,
minus 0.5%.
One of the things that there's fees associated where the bank might not be or might be making the money back. But Scott, here's what would perplex me is that corporate bonds, many corporate bonds in parts of the European Union are negative as well. And I always thought, why don't they just, rather than buy those, why don't they just actually just go out and buy a foreign bond? And you're like, why don't they buy an American bond? But then they expose themselves to not only interest rate risk, but currency risk as well. And there's a cost to hedge that currency risk. So maybe it's just better off accepting a negative interest rate than it is to hedge your currency risk. You think?
Well, that's exactly what it is. But when you think about, we're in this environment where investors are willing to say, I'm going to lose my money.
Lose money.
And all you need to do is pay me back
some of it.
Most of it.
So what is that? That tells us that we're in a zero inflationary environment.
So roughly 25% of the global debt market is now trading in negative ground.
What does this mean? What's it mean? I think what it does mean is
$15 trillion worth of government debt is at negative yields. Well, I mean, if our U.S. government, we're not negative yet, but we're pretty dang low. If we can borrow money on a negative basis, it would certainly mean that who cares about deficit spending anymore?
it would almost encourage
Of course.
But so what does it mean? What happens though when we get in the negative territory? The ability to supercharge an economy through the use of interest rates, which is what the Federal Reserve did the last time around, becomes minimized, and then they have to start looking for other things such as tax policy, economic policy, other than interest rate policy. Right?
Even bonds issued by, get this, negative rates, Poland, the Czech Republic, Hungary. Would you, to think about, Pat, there are institutions, there are individuals that have said, I'm going to loan money to the Czech Republic. Not only am I not going to charge them an interest rate, I'm going to let them keep a little bit of my principal.
But if you're in the Czech Republic and Czechoslovakia, it may be the best alternative for you if you're there because of investing outside of.
Oh, I understand, but it's
it's a place that we've never really seen before, and maybe it's taken place, and that.
Well, we saw it in Japan a couple decades ago, but it was short-lived phenomenon. Then it went.
But it wasn't. It didn't spread much past Japan. So maybe this has taken place in historical times that we're not aware of, and maybe the data collection is just that much better.
Well, how far back in history?
That's
do
what
you have
I'm
to go?
talking.
No, they're saying that. No, I mean, everywhere you read this has never happened before. I mean, you certainly don't hear about the money lenders.
Yeah,
of
negative interest rates. I think they couldn't. It was harder to collateralize things back
Is
then.
it usury if it's only minus 0.5%? It should be minus 5%. Otherwise,
it's an interesting place. It's an interesting place. So what does it mean? So we're listening to the show right now, Scott. What does this mean if we're seeing negative interest rates? It's not affecting us here in the U.S., although we have moved to a U-shaped or negative yield curve, depending upon what you're measuring from beginning to end, which historically has said,
I mean, it would seem to me that the markets are signaling a deflationary environment, not inflation, deflation,
and a possible
Prices
recession. And a possible recession.
Because you would say, I'm going to put my money just about I'd rather go buy a piece of land, buy anything, other than having a negative return. Unless your concern is that
those asset prices are too high.
Fall even further.
And that you'd accept something as a negative.
I just think it's fascinating. And as your point here, what's this mean to the average investor? And it's just
what does it mean to we don't actually wish you knew. I wish I knew. We don't know. What we do know is over long periods of time, asset prices.
What we do know is we're not allocating any of our clients' money to negative rates, and
we know that. We know that we're not buying negative rate, but we're not investment advisors in Czechoslovakia or Poland either.
I don't think Czechoslovakia exists anymore. It's the Czech Republic.
Excuse me, the Czech Republic,
or USSR,
the Czech Republic,
the Soviets.
Enough.
The Bolsheviks.
So, but we're not there. We're not in that environment. We're in this environment.
All right. Well, let's. Anyway, I'm baffled by it, and I'm baffled when you see Sweden. A bank in Sweden is offering a mortgage that carries with it a negative interest rate, and this is not a teaser rate. This is not based in.
No,
it's not that your payment is negative. The true cost of money
is negative. Yeah.
Yeah. Anyway, all right. Let's.
But it hasn't seemed to actually help their economy much. It hasn't spurred home.
No.
It's almost like a non-event. Imagine if you had a negative interest rate here. Well, it didn't happen overnight either, so it slowly came down. It didn't go from a 4% interest rate to a negative interest rate in 2 weeks.
That is correct.
So,
there is a chance that sometimes sometime in the U.S. we have some negative rates.
But my point being is, if it didn't happen overnight, then the markets would titrate to that.
All right. Well, let's take some calls on something that's not quite so esoteric as negative interest rates on government bonds. 25% of the global government debt is negative interest rate. It's not like it's
hard to believe.
I mean,
are you sure that number's right?
According to my sources,
25%.
Yeah, 25%. $15 trillion. There's $60 trillion.
Global debt.
20 trillion of it's 21 is the U.S.
Yeah.
And by the way, China does not own the majority of our debt. I think China's less than.
Who owns the majority of U.S. debt?
U.S.
U.S.
U.S. citizens
US
through some
citizens.
sort of intermediaries.
Yes.
Yeah.
Yeah.
And the Chinese is less than 10%.
Yeah.
So they used to own more. But anyway, all right, let's take some calls to be part of the program. 1-833-99-WORTH. I'll get you on the program. 1-833-99-WORTH. And we're talking with Larry. Larry, you're with Scott Hansen and Pat McClain of Allworth Financial.
Good morning, gentlemen. How are you today?
Wonderful. How are you, Larry?
I'm very reasonable for an old fella.
Reasonable.
Thank you.
Good. You're reasonable. All right.
No, very reasonable. But
Very okay. Good. Thank you.
The reason I'm calling today, I'll give you a brief synopsis of what's happening. I'm getting a lump sum workers' comp settlement. The brief overview is this: injured in 2013. After 4 surgeries during this time frame, I was declared permanently disabled, and I'm coming to the closure of my case. Before I get to the minutia of it, I want to give you a little side caveat that I'm getting married to a wonderful woman in August who is a nurse for a large hospital here in California, and I'm going to have some excellent primary insurance. What this structured settlement, from what I'm reading, is I can only deposit this money in a bank account, FDIC bank account, which is very low interest, as you know. My question is there anything you guys can recommend? Because I don't see me using this money over and above her insurance. It's very structured. So my question is, what can I put this money in that could earn some extra not income, but just build on its base?
So I question the FDIC premise that you just talked about. So oftentimes the insurance company that is paying out the claim will allow you to use a menu of their recommended companies in order to invest the dollars. So they'll say you can use these, and there are certain life insurance companies that actually practice in the structured settlement marketplace that aren't normally with products that aren't available.
Well, you said it was a lump sum, and you said it was structured. So is it a lump sum or is it structured?
No, I misspoke first. It's not structured. It's lump sum. And in the booklet that I'm researching, it says that it's FDIC insured account. And now my lawyer said to me, well, I can pull out $10,000 and go have a vacation, and I think he's totally wrong, but that's for another day and scotch. But so I guess my question is because I'm getting married and my future wife has excellent insurance, I don't see me using this money. And the last thing it says, or one of the things it also says in there, is that if there's money left over upon my death, I can leave this money to my children. And so me personally, I would like to have, I'm going to do that because I think there'll be money left over. But we're only talking about maybe $100,000 here. So I just don't know I don't know what to do with it.
So it's you have a negotiated agreement with an insurance company.
You can do anything you want with this money.
Well, it depends on what it depends on what was negotiated, what Larry negotiated. There's an attorney negotiated on his behalf. So if you said the money's only going to be used for buying shoes for kids without shoes, if that's what you agreed to and you have a legal document, then I suppose that's what you're bound to.
I've never heard such a thing.
Well, that's what I haven't either. So that's what's
I've
confusing.
heard of structured settlements.
But this is a lump sum. So once it's a lump,
I've actually seen lump sum structured settlements as well, but where they give you a list of investments that you can put it in. You don't have any choice in the matter.
I don't have any choice in the matter according to what documents I've read so far.
Okay, well then what's your question for us?
Well, I just wondered, I was talking to the smart guys, because I'm not all that smart, to see if maybe they had experienced this before and said, well, I could put it in this, maybe this little bit better interest-bearing account over, let's say, just a user bank, Chase Bank.
Yes. But historically, so the ones I have looked at in the past, the company that is paying out the claim, the workers' insurance company that's paying out the claim, or these were sometimes, I actually saw a dog bite, a large claim, multi-$100,000 claims, and insurance for auto accidents. The insurance company that's paying the claim out will say, here is a menu of 3 things you can choose from that we will deposit your dollars in, and then the contract will actually be adhered to based on that. I assume that's what you're having, right?
I'm not to the final table yet, so I'm just kind of trying to do some homework.
Oh, well then tell them you want more options than an FDIC insured.
Yeah, tell them you just want the money paid out as a lump sum. And then you can take it and you can do anything you want with it. You can invest it in the stock market, or you could invest it in CDs, or you can do whatever you want with it. But you can actually ask them to pay that out as a lump sum if you wish. Will they do it or not? They may not. I don't know.
Yeah.
But you can ask them anything you want.
That's what I would ask.
Medicare it's all tied up in the Medicare set aside portion is what this money's geared towards.
Oh, got it. No, there's no choices. There's no choices. It's the Medicare. That's it.
Okay.
That you got no choices.
Yeah.
All right. Well, then you guys answer my question.
I appreciate it. It took us a while to get to the answer.
Yeah, well, we got the new information right at the very end.
Yeah. All right, appreciate the call.
Yeah, sorry, Larry. And
so all that means is that they're giving him money to pay for his health insurance for the rest of his life.
Let's continue on with some calls. And again, we love taking calls from our listeners. And by the way, if during the time of this airing, oftentimes we pre-record our calls. If this isn't a convenient time to call to ask your question, call us. We will schedule a time
that's
convenient when we sit in the studio, and sometimes we'll sit in the studio for 3 hours in a row and take calls, etc. So, again, to be part of the program, either sometime that is convenient for you, it's 1-833-99-WORTH. Let's go talk with Priscilla. Priscilla, you're with Allworth's Money Matters.
Oh, good morning.
Hi, Priscilla.
Hello, can you hear me?
Yes.
Yeah. Most of the advice I hear is for younger people or people about to retire, but I'm in my mid-80s. My husband is in his early 90s, and I'm wondering whether we should be investing in cash, short-term treasuries, that kind of thing. Right now, we have some money in the Vanguard and some short-term treasuries.
And of your portfolio, Priscilla, what percentage of it is in stocks?
About half and half.
And do you think you'll spend at least half of these dollars in the rest of your life?
No, I'm not counting on it.
Are you spending any money of this investment money now, or the dollars that
No,
nothing.
we're not.
Nothing.
And then what's
I'll have a little more to invest, and you never know. We're healthy right now, but you never know what's going to happen. So I'm just.
Where are you getting more money to invest? Do you have? Where's that coming from?
I have a business I've had for several years, and we have an income of about $45,000 a year, in addition to our Social Security.
And you're both still working?
Well, yes.
Oh, good for you. I don't think there's anything wrong with what you got.
I would not change anything.
I don't. What you have sounds perfect. And how long have you had it?
Had the business?
No, the investments.
Or what?
The investments.
Just been adding over the years.
Like 20, 30, 40 years?
20 years.
Yeah.
Jack Bogle, the founder of Vanguard, you mentioned Vanguard. So he recently passed away a few months ago. He was in his 90s, I believe. he had a heart transplant. He had all kinds of health issues and somehow managed to continue on. But I was at a conference once. Someone asked what his personal portfolio was. He said it was about half in stocks and a half in fixed income. That was the founder of Vanguard. You've got a familiarity with them. You've been with them a long time. I don't think anything's wrong at all. Just because you get older does not mean you need to suddenly be all that more conservative.
Especially if you're not going to spend it because you're investing these dollars for your heirs or a charity. So I think the portfolio you have today is perfect for you. You're familiar with it.
If you said you needed to spend all these dollars next year for something, like we're gonna whatever, then would say stocks are totally inappropriate. But just because you're in your mid 80s or mid 90s or 105, I mean, there's no reason that your portfolio could have a long.
Yeah. In fact, your portfolio doesn't even know how old you are.
Good point.
All righty.
All right. Thank you.
I appreciate
Thank
the call.
Yeah, it's encouraging,
Bye-bye.
actually.
Really is. It's great.
Yeah.
Mid 80s?
Yeah.
Early 90s?
Still involved in some business?
Some business?
Yeah. I have a neighbor that he must be 86 or 87 now. Runs a business, gets up early and drives to work every day. Not that he doesn't need to. Financially, he doesn't need to, but.
Is he?
Yeah. And let's continue on talking with Teresa. Teresa, you're with Allworth Financial.
Gentlemen, thank you for taking my call.
Thank you.
You bet. I'm calling because my mother passed away last year at 93. A great inspiration. She used to work at the local high school and was able to save money to give to her 5 children. And what I'm asking, my question is, I would love to be able to do something for her great-grandchildren. They are 2, 5, and 12, and I don't know exactly where to put that money into. Probably about $5,000 to $10,000 each, and I'm hoping that you might help me with that.
What would you like that's a wonderful thought. I think it's great, by the way. What would you like these dollars for?
Probably for their college education is what I would hope that they would use it for. If that's not their destiny, then something that they could use maybe to purchase a house or be able to use that money wisely in their future.
So and how old are you, Teresa?
I'm 62.
Okay, so you've got another 31 years at least, like your mother.
If you were anything like your mother.
That's up to her, right?
So if it's for college, probably the best program is what's called the 529 plan, and every state's got them, and it's basically the money goes tax deferred. If the funds are used for college expenses, they come out tax free. Any money, and that could be not just like 4-year college. It can be for junior college, covering your books. It could be a trade school. It could be a other sort of certificate program. So it just has to be used for education.
You would remain the owner of the assets, and they would be the beneficiary of the 529 plan, the scholarship program, the 529 plan.
Okay.
So it's easy enough. Most states have what's called an age-weighted or an aggressive age-weighted plan. You would put dollars into those. And I'd probably use the aggressive age-weighted plan. So all that means is that
would that be a higher return? That what the aggressive?
Yeah, so it doesn't necessarily guarantee a higher return, but what it does do is that the younger the child is, the more aggressive the portfolio is because the longer the length of time before they use the dollars. So as an example, the 12-year-old is actually going to have a lot less stock in it in that particular plan than the 2-year-old. And as the 2-year-old gets older, they make the portfolio more conservative every year until the age of 18, when the presumption is that the child will be going to college at the year soon, hopefully at 18 or 19. If the child does not go to college, you can decide to distribute the money to the child, at which case you will then pay a 10% penalty and all taxes due on that. But it's a great way.
Penalty only on the growth.
Yeah, penalty only on the growth. And I could tell you, I used it for all 4 of my children, the 529 plan for their college funding. And I started funding it when they were born. In fact, there was an advisor at our firm before he got married. This is optimistic. Before he got married or even met a girl, he was funding a 529 plan.
Really?
For
That's planning, man.
For his kid.
Yeah,
So-
that's a planner.
That is optimistic.
Teresa, so your grandkids are of different ages, correct? So
Correct.
if
2,
you want
5,
to,
and 12.
yeah, if you want to plan for $10,000 at college age, I ran some numbers. So assuming a 5% growth, if you contributed $7,300 to the 12-year-old, assuming 5% growth, that should be $10,000 by the time they go to college. For the 5-year-old, that's $5,300, and for the 2-year-old, it's $4,600. So in other words,
Okay.
right? So the 12-year-old, you put $7,300. The 5-year-old, you put $5,300. The 2-year-old, you put $4,600. It's roughly going to all equal about $10,000 when they reach college. I didn't account for inflation, so you could kind of play. So in other words, you might want to kind of play with these percentages and think about it like that. Because the different age, that actually might be more equitable than just giving them the exact same dollar amount today.
Oh, okay, that does make sense. And then I can add to that as
Yep.
I go to that 529. And do I go to a bank? What would you suggest? Or is there going to be somebody taking care of that money that I'll have to pay a fee?
There's always a fee when your money's being managed. So, but there's some low cost plans out there. I just simply Google low cost 529 plans and set one up online.
Okay.
They're
All
really
right,
simple.
Very good. Thank you, gentlemen.
All right. Wish you well. Well, that is just about all the time we have. For our podcast listeners, we are asking you to continue on. We are doing an extra extended podcast where we are talking about a couple that's trying to figure out their taxable income. Well, they've got many different retirement accounts and trying to figure out what's the best way they should structure this as going into retirement. So that will be in our podcast, extended podcast. And if you are not a subscriber to our podcast, we would encourage you to do so. Just if you go to iTunes, you can get it through there, or go to our website, allworthfinancial.com, and it will teach you exactly how to go about getting our podcast. So unfortunately, this is all the time we've got this week. It's been great being here with you, and we hope you enjoy the rest of your week. This has been Scott Hansen and Pat McLean of Allworth Financial. All right. Thank you very much for being podcast subscribers. And so periodically we do a little extended podcast where we'll deal with another question, typically something that someone writes in. And so we had a guy named Kevin.
Wait, Scott, before we go there, this is Pat speaking. I want to thank you for being a subscriber to our podcast. And
if you've still listened thus far, all 4 of you.
If you've reviewed us, we appreciate it. If you haven't, we would appreciate that. Due to regulatory framework in which we work, we cannot ask for a positive review, but I can ask you to review the show. Wink, wink. And the other thing is the number of people that have been subscribing has gone up. If you like this, share it with a friend. Think of one friend.
If you think you've got somebody that maybe is retiring soon and thinks that our topic can help them. We do believe that the more one is educated, the wiser decisions they're going to be making with their money.
So that's all we ask, that you pass this on to a friend. And actually, Scott came into the office this morning and he said, "Did you mean to send me this?" It was another podcast called The Hidden Brain, which is one of my favorites. And he said, "Did you mean to send this to me?" And I said, "Absolutely. It's one of my favorite podcasts, and I share the many podcasts, not my own, obviously, that'd be too self-serving, but I share many with my children and business partners."
Yes. So, all right, here's the question that Kevin wrote in. I'm 63. My wife is 61. We're a couple years away from retirement, and all of our savings are in traditional retirement accounts, 401k, 403b, IRAs. We've got about $1.25 million. Between those dollars, Social Security, and a teacher pension, all of our retirement income looks taxable. Is there anything we should do over the next couple years to address this? I keep hearing about strategies to reduce taxes in retirement like Roths. Did we miss the boat? A little. I mean, in a perfect world, we get to retirement with a diversified retirement tax strategy. So just like we have diversification in our investments, right? We don't want all one sort of thing. We all understand that. If we can get to retirement where we have a diversification strategy with our investments when it comes to taxes, that's helpful too. And how might that be accomplished? Well, if you get to retirement and you've got a chunk in your taxable retirement accounts, 401ks and IRAs, perhaps also a chunk in Roth, which should be great to do, and perhaps some money saved up outside of that. Maybe you've got a brokerage account set up, or you've got a mutual fund outside that something you've contributed to, or even some stock, some money in a savings account, money market.
But Scott,
in an ideal, I'm just talking about in an ideal world, you go into retirement like that.
That's theoretical.
Well, no, that could take some planning as well.
I understand, but
I mean, if you're 10 years away from retirement,
then it may be a strategy. It may be.
It still might make sense to max out those 401ks.
Because when you look at this and it says I'm 63 and my wife is 61, and what we do know is one of them's a teacher and is going to get a pension, and the other looks like they're going to get Social Security, assuming that the windfall elimination provision applies to them.
Well, if we're highly confident that we're nearing retirement, and we're highly confident our tax bracket will be lower once we retire,
or the same.
So hear me out here. Lower once we retire, we should put as much money in our retirement accounts.
That's correct.
If we know it's going to be lower, clearly, I don't care about forget the diversification thing I just talked about. We want to take advantage of maximizing our 401k. And if we have no other dollars to save, then we get to retirement with a bunch of money in taxable retirement accounts and little else.
We don't have the benefit of actually
not.
asking questions, but we can use our years of history dealing with people, working with people like themselves. My guess is that they didn't either help or hurt themselves by putting all this money into their...
No, but if you are still going towards retirement and you have the ability to, say, contribute to a Roth IRA or a backdoor Roth IRA...
Even better.
Or you've maxed out your company's savings plan, you've maxed out your Roth, now you're saving, maybe it's a mutual fund you've got, maybe it's just a savings account, you build up some other savings, that would be preferable.
Yeah, but in this situation, I'd continue the 403b, 401k contributions until you retired, and then I would look at Roth conversions between that point of retirement and the years of required minimum distributions.
Very few people have higher taxable income the year after they retire.
Very few.
That's frankly a good problem to have. So anyway, appreciate very much you being podcast subscribers to Allworth Financial. We'll see you next time.
This program has been brought to you by Allworth Financial, a registered investment advisory firm. Any ideas presented during this program are not intended to provide specific financial advice. You should consult your own financial advisor, tax consultant, or estate planning attorney to conduct your own due diligence.